Welcome to vTalkInsight, Risk Sentiment Daily for January 15th, 2026. Volatility has just seen its sharpest jump since November, even as capital quietly rotates across sectors and into hard assets. Today we unpack how that mix of rising anxiety and persistent risk appetite is reshaping market sentiment. Across markets, risk sentiment is best described as two-way with a clear defensive tilt. Headline U.S. equities have slipped for a second session, and volatility indices have logged their largest rise since November, signaling mounting unease around the macro and policy backdrop. Yet beneath that surface, breadth is healthier than the index level suggests, with a majority of large-cap constituents advancing even on down days for the benchmark. That pattern points more to rotation and repricing than to an outright rush for the exits. Capital is moving out of last year's mega-cap winners toward areas that had been underowned. Small caps, energy, materials, and selected cyclicals are all seeing renewed interest. Recent sessions show the Russell 2000 outperforming the S&P 500 for an extended run, something we have not seen in decades. At the same time, emerging market fixed income and non-dollar assets are being favored as investors look for diversification and potential upside from a gradually weaker U.S. dollar and improving fundamentals abroad. Overlaying that rotation is a strong bid for hedges. Gold and silver are at or near record highs, with miners rallying as investors respond to geopolitical headlines, questions around central bank independence, and worries over asset bubbles in parts of the market. Longer-dated volatility expectations are drifting higher even while near-term gauges remain relatively contained, underscoring a market that is still willing to run risk but is increasingly focused on tail protection. Against that backdrop, three main headwinds and three key supports are defining today's risk balance. Rising geopolitical and geoeconomic risk premia are the dominant headwind for markets right now. Tensions around Iran have already driven notable oil price spikes, with analysts focused on the potential removal of roughly 1.4 million barrels per day of Iranian crude from global supply. Current forecasts see Brent moving toward $70 and WTI toward the high 60s on risk premium alone, even though actual production disruptions remain limited so far. That gap between realized supply and priced risk keeps energy a central transmission channel for geopolitics into broader markets. Geopolitical stress is not confined to the Middle East. A global risk survey now ranks geoeconomic confrontation near the top of the risk spectrum, reflecting worries over tariffs, sanctions, investment controls, and the steady erosion of international policy coordination. These frictions are already reshaping trade and supply chains, from concerns about U.S. tariff policy and potential refund rulings to rising defense spending in Europe, where a major ammunition producer is preparing to list amid strong investor interest. The message is that geopolitics is becoming a structural, not just cyclical, driver of risk premia. One direct consequence is the powerful rally in precious and base metals. Gold, silver, and copper have all surged, supported by both safe haven flows and narratives around currency debasement and supply bottlenecks. At the same time, G10 rates and major currency pairs have often shown muted headline reactions, suggesting that for now the main spillover channel runs through commodities, selected equities such as energy and defense, and long-term volatility. Investors are watching whether further escalation forces a broader repricing of inflation expectations and discount rates, or whether abundant spare capacity in oil and global production buffers these shocks. Political pressure on the Federal Reserve and the broader regulatory backdrop has become another significant source of uncertainty. Public calls from the administration for lower rates, together with criticism of Chair Powell and contentious nomination battles in the Senate, have raised concerns about the Fed's independence. Some analysts warn that if policy were seen as politically driven, inflation expectations and long-term yields could jump, forcing a repricing of equity valuations and raising the risk premium on U.S. assets. There are also ongoing legal proceedings involving Fed leadership that could delay key congressional testimony and complicate communication on monetary policy and supervision. Global central bankers have voiced support for Fed independence, underlining how central this issue is for international confidence. For now, though, U.S. Treasury yields are only a few basis points lower across the curve, indicating that markets are not yet assigning a high probability to extreme scenarios around the Fed's mandate or governance. Alongside the Fed story, domestic policy proposals are creating a separate overhang for financials. Ideas such as a 10% cap on credit card interest rates and legislation targeting interchange fees are weighing on major card issuers and large banks, with executives warning that aggressive caps could materially constrain credit availability and profitability. This policy noise is shifting the focus of upcoming bank earnings away from pure profitability toward regulatory risk, even as many institutions report strong loan growth, record net interest income, and still benign credit quality. The net effect is a higher required risk premium for the sector without a clear baseline yet on which proposals will actually pass. Sticky inflation and higher-for-longer rate fears are the third major headwind. Producer price data surprised to the upside, with overall PPI running around 3% year-on-year versus estimates nearer 2.7%, and core PPI at 3.5%, revisiting levels from earlier in the year. Retail sales also beat expectations, rising 0.6% month-on-month and showing broad-based strength, particularly in headline and core measures. Combined with a still resilient labor market, that mix makes it harder to argue for imminent aggressive rate cuts. Inflation break-evens over the next 3 years have edged up from roughly 2.25% to about 2.4%, and investors are watching closely for any sustained break higher that could flag renewed inflation risk. At the same time, markets are positioned for policy rates to fall toward 3% by year-end, implying several cuts from current levels. Policymakers, however, are signaling a more conditional stance, with some expecting only 1 or 2 moves, and only if inflation convincingly returns to target. The higher rate environment is already visible in real assets and credit. 10-year Treasury yields are roughly double their average from the early 2010s, weighing on commercial real estate valuations and setting up a challenging refinancing wall, with about $1 trillion of loans coming due in 2026. Elevated mortgage foreclosures and persistent cost of living pressures for households add to concerns that, while headline inflation has moderated, affordability strains could still cap growth and feed political responses. For portfolios, this backdrop argues for close attention to interest rate sensitivity and refinancing risk across property and leveraged credit. Set against those headwinds is a still resilient growth and soft landing narrative. U.S. GDP is projected to run around 3% through the first 3 quarters of 2026, easing only modestly toward the low 2s by year-end, especially if political gridlock emerges. Even as the labor market has lost some momentum, strong productivity gains appear to be offsetting weaker job creation, helping keep unemployment contained while supporting corporate margins. Consumer spending remains surprisingly sturdy. Retail sales are rising faster than expected, and while much of the latest strength comes from higher-income households and higher prices, the data still point to a near-term boost for earnings. On top of that, a sizable fiscal impulse from new U.S. legislation is expected to start supporting activity as early as February, at a time when banks are reporting strong loan growth and improving credit quality in areas like autos and credit cards. Large U.S. banks are citing solid GDP growth, robust capitalization, and healthy net interest income as reasons for optimism, even if expense pressures and policy risks complicate the picture. Energy equities are also attracting flows, helped by strong free cash flow yields and still attractive valuations after a long period of underperformance. This combination of steady growth, moderate disinflation, and sector-specific tailwinds supports a soft landing scenario in which credit fundamentals stay intact and cyclical parts of the equity market continue to participate, even as investors grow more selective. Fed easing expectations continue to support risk assets, even as the timing and scale of cuts remain debated. Markets are positioned for policy rates to drift down toward 3% by year-end, and many investors still anticipate 2 or 3 cuts as disinflation progresses. Some official commentary points instead to 1 or 2 moves, contingent on inflation returning to around 2%. But the direction of travel in expectations is clearly toward easier policy rather than further tightening. This outlook is shaping positioning along the curve, with preference for the front-end and 5-year sector, where the risk-reward is seen as skewed toward lower terminal rates and a potential steepening. It is also feeding into a view of a gradually weaker US dollar as the Fed eases, while some other central banks, notably in Japan and Australia, lean tighter or have already cut. That softer dollar narrative, together with lower prospective real yields, underpins demand for emerging market debt, precious metals, and housing-related assets, as seen in the surge in mortgage refinancing and rising purchase applications when rates briefly dipped. Finally, broadening equity leadership and rotation are crucial supports for overall risk sentiment. Market leadership is shifting away from a narrow group of mega-cap technology names towards sectors such as energy, materials, industrials, and selected consumer areas. Small and mid-cap stocks are outperforming, with the Russell 2000 beating the S&P 500 for multiple consecutive sessions and attracting increased investor flows after a long stretch of underperformance. This rotation is helped by relatively attractive valuations in banks, smaller industrials, and commodity-linked names, as well as by structural themes like reindustrialization, reshoring, and increased fiscal spending on infrastructure and defense. AI adoption is also broadening beyond pure tech, supporting productivity and operating leverage in value-oriented sectors such as industrials and healthcare. The result is a less concentrated equity market where investors are reallocating rather than retreating, potentially making the overall risk complex more resilient even as headline volatility climbs. To sum up, markets are juggling a two-way profile. Geopolitical and policy risks, sticky inflation data, and questions around the Fed's independence are pushing investors to pay up for protection, even as resilient growth, expected Fed easing, and broadening equity leadership keep risk appetite alive. Watch how oil, metals, and long-end yields respond to incoming headlines and data, and whether sector rotation and safe haven demand can continue to coexist without tipping the balance toward a more decisive risk-off regime. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.